What happens when you take $10,000 and put it across the 3 best Fidelity index funds? John had the same question, and it depends on how the portfolio gets built. One way, John ends up getting paid $2,000 every single month for life. The other way, same $10,000, same 3 funds, that account grows into nearly $700,000. In this video, John takes $10,000 and invests it across the 3 best Fidelity index funds the platform has to offer. One for dividends, one for growth, and one for international exposure. Then he builds 2 completely different portfolios out of those same 3 funds. One tilted for income, one tilted for growth. And by the end, I'll show you how one portfolio pays him $2,000 a month for life, and how the other one turns the same $10,000 into a $700,000 portfolio. So here's where John starts. He looked at every index fund Fidelity offers, and he keeps coming back to the same 3. One for income, one for growth, one for everything outside the United States. Every portfolio worth building needs all 3 of those jobs handled, and these are the funds that handle those jobs the best. A quick note before we get into them, a Fidelity index fund is just a basket of stocks that follows a set rule. There's no manager picking and choosing winners. The fund just owns whatever's in the index it tracks. That's why the fees are so low and why these funds work so well over long periods. Now let's look at those 3 funds. The first fund is FDVV, the Fidelity High Dividend ETF. This is the one built to pay John. It tracks large and mid-cap U.S. companies that pay high dividends and are expected to keep growing those dividends over time. The top holdings are names you already know: NVIDIA, Apple, Microsoft, Broadcom. And if you're thinking those aren't dividend stocks, that's a fair reaction. Most people picture dividend funds as boring utilities and old-school energy companies. But here's what's happening. These tech giants got so big that even a small percentage of their profits comes out to massive dividend payouts. Apple alone paid out over $15 billion in dividends last year. So FDVV isn't just chasing yield from sleepy companies, it's holding the biggest, most profitable businesses in the world, and at the moment, those businesses are starting to pay real income back to shareholders. Now a quick note on what a dividend actually is. A dividend is a piece of a company's profits that gets paid back to shareholders, usually every 3 months. The more shares you own, the bigger the check. That's the whole game. FDVV runs at a 2.8% dividend yield with a 5-year dividend growth rate of 10.85% and an annual share price appreciation of 9.16%. And that combination is what makes it the income engine of John's portfolio. So that's job number 1 handled, income covered. Now John needs growth. The second fund is FNCMX, the Fidelity NASDAQ Composite Index Fund. This is the one built to grow the account as fast as possible. It tracks the entire NASDAQ composite, around 3,000 companies heavily weighted toward technology and innovation. And quick context here, because this trips a lot of people up. The NASDAQ isn't a fund or a company, it's a stock exchange. Most of the big tech companies in the world list their stock on it, which is why a fund that tracks the NASDAQ ends up so tech-heavy. The top holdings are Apple, Microsoft, NVIDIA, Amazon, Meta. Same names as FDVV in some cases, but at very different weights. FDVV picks them for their dividends. FNCMX picks them for their growth, which you can see from the tech holdings percentage sitting around 50%. The numbers clearly tell that story. FNCMX runs at only a 0.48% dividend yield, a 6.91% dividend growth rate, but has a 17.45% annual share price appreciation. And that 17.45% is the highest of any of the 3 funds in this video. So now, John has income and growth. But everything in the portfolio so far is American. A good portfolio also needs global diversification. The third fund is FTIHX, the Fidelity Total International Index Fund. This is the one that gives John exposure to everything outside the United States. It tracks over 5,000 stocks across developed and emerging markets, basically the entire world that isn't America. Quick context. Developed markets are countries like Japan, the UK, Germany. Emerging markets are countries like India, China, Brazil, economies that are still growing into their full size. The top holdings here aren't household names for most American viewers. Companies like Taiwan Semiconductor, Nestle, Novo Nordisk, ASML. And honestly, John almost skipped this one. International stocks have underperformed U.S. stocks for over a decade. So why would he buy something that's been losing the comparison? Simple. Because every portfolio needs something that doesn't depend on America. If the U.S. has had a bad decade, this is the fund that holds the floor. And there's something else about FTIHX that doesn't show up at first glance. FTIHX runs at a 2.54% dividend yield, a 6.2% annual share price appreciation, and a 5-year dividend growth rate of 16.98%. And that 16.98% is higher than either of the other two funds. The international fund that nobody talks about has the fastest growing dividend of the three. So now we have our portfolio: income, growth, and rest of the world. But here's the part most people miss. Picking the funds isn't actually the entire decision. One of the most important aspects of John's decision is how much weight he gives each fund. Because these same three funds can be built two completely different ways. Tilt the weights in one direction, and the portfolio pays him every month. Tilt them the other direction, and the account grows into something much bigger. Same $10,000, same three funds, the weights he gives each fund is the strategy. Next, I'll walk you through the dividend-tilted portfolio, the version that pays John $2,000 every single month for life. And in the end, you'll see how the growth-tilted version takes that same $10,000 and turns it into a $700,000 portfolio. But first, let's see how John builds the portfolio that pays him. This is the dividend-tilted portfolio, and the weights look like this. 50% goes into FTIHX, the international fund. 30% goes into FDVV, the dividend fund, and 20% goes into FNCMX, the growth fund. Now, if your first reaction is, wait a minute, why is the international fund the biggest slice of an income portfolio? That's a fair question. Here's the answer. FTIHX has the highest dividend growth rate of the three at 16.98%. Over time, that is the engine that compounds the income the fastest. FDVV gets 30% because that's where the immediate yield comes from, the cash hitting John's account today. And FNCMX is only at 20% because this portfolio isn't built to quickly grow the account. It's built to pay him. In this scenario, FNCMX becomes the small growth anchor that keeps the account from stalling. And here's the part that flips the framing. Even with 50% in international, the U.S. side of the portfolio still adds up to 50%, FDVV plus FNCMX. So this isn't John abandoning America, it's John splitting the portfolio evenly between the U.S. and everywhere else, while allowing the international fund to do the heavy dividend lifting. When you put those three weights together, the dividend-tilted portfolio comes out to a 2.2% blended yield, a 13.13% blended dividend growth rate, with 9.14% annual appreciation. Quick note on what blended means. It's just the average of the three funds once you factor in how much each one John actually owns. Here's how that portfolio is projected to play out for John. After year 1, the $10,000 would be worth $11,134. Modest, nothing dramatic. After 10 years, projections show it growing to $30,453. After 20 years, $103,773. And by year 30, the portfolio is projected to reach $416,613. But the account size isn't actually the headline here. The headline is what that account would be paying him. In year 30, the dividend-tilted portfolio is projected to pay $2,048 every single month for the rest of his life. That's $24,577 a year hitting John's account whether the market is up, down, or sideways. Of the $406,613 the portfolio would add on top of the original $10,000, $255,067 would come from capital appreciation. That's the share prices going up over time. The other $151,546 would come from dividend reinvestment. Okay, quick context on what reinvestment means. When the dividends are paid out, instead of taking the cash, John uses those dividends to buy more shares of the same fund. Those new shares pay their own dividends, which buy more shares, which pay more dividends. Over 30 years, that snowball gets enormous. And that's why almost 37% of John's projected growth in this portfolio would come from dividends compounding on themselves. That's not a small number. That's nearly 4 out of every $10 of growth being generated by the income side of the portfolio. So that's the version built to pay John, a projected $416,613 in the account, $2,048 a month. But that's only one way to build it. And John knows there's another version of him watching this, a version that doesn't care about a monthly check, a version that just wants the biggest possible account at the end. So what happens when John takes those exact same 3 funds and weights them in the opposite direction? The weights flip almost completely. 70% now goes into FNCMX, the growth fund. 20% goes into FDVV, and only 10% stays in FTIHX. The reasoning shifts. FNCMX gets 70% because its 17.45% appreciation is the highest of the 3 by a wide margin, and this portfolio rides that growth as hard as possible. FDVV drops to 20% because in a growth-tilted portfolio, dividends aren't the priority. It's just enough to keep some income in the picture without slowing the account down. And FTIHX drops to 10%. International diversification still matters, but at this weight, it's a hedge, not a core position. So with these new weightings, the growth-tilted portfolio runs at a 1.15% blended yield, an 8.71% blended dividend growth rate, with 14.67% annual appreciation. And in this portfolio, that 14.67% is what will do almost all the work. So if the goal is a bigger account, this is what it looks like. After year 1, the portfolio would be worth $11,582, almost identical to the dividend version. After 10 years, projections show it growing to $42,454. The gap is starting to open. After 20 years, $173,989, and by year 30, the portfolio is projected to reach $699,558. Here's where this portfolio is obviously different. Of the $689,558 the portfolio would add on top of the original $10,000, $675,422 would come from capital appreciation, while only $14,136 would come from dividend reinvestment. That means almost 98% of John's projected growth in this portfolio would come from share prices going up, not dividends, not reinvestment, just appreciation. And there's a reason for that. When the funds in this portfolio don't pay much in dividends, there's nothing to reinvest. The whole engine becomes share price growth, which is bigger, but it's a different kind of money. It's money on paper, not money in your pocket. which is exactly what shows up in the monthly income number. By year 30, the growth-tilted portfolio is projected to pay $98 a month. For the entire year, that's $1,179 in dividend income. That's the trade. Bigger account, smaller check. So now, both portfolios are sitting next to each other. Same 3 funds in both. Same $10,000 going in, 30 years on the clock. The dividend-tilted portfolio is projected to reach $416,613 in the account, paying $2,048 a month. The growth-tilted portfolio is projected to climb to $699,558 in the account, paying $98 a month. The bigger account pays 21 times less than the smaller one. Now, some viewers are doing the math right now and thinking, hold on, $699,558 with a 4% safe withdrawal is $27,982 a year. Well, that's $2,332 a month. That actually beats the dividend portfolio's $2,048. So isn't the growth portfolio still the better income play? I'll answer that in a minute, but quick context here. The 4% rule is a guideline that says you can safely pull about 4% of your portfolio out each year in retirement without running out of money. It's the standard rule of thumb for living off your investments. And on paper, that math works, but here's what changes in practice. With the dividend portfolio, John doesn't sell anything. The $2,048 a month would come from dividends being paid out. The account itself stays whole. The shares stay invested. The dividends keep paying him forever. With the growth portfolio, every withdrawal eats into the account. He's selling shares to pay himself. And if the market drops the year he retires, he's selling shares at a loss to live on. That's called sequence of returns risk, and it's the single biggest reason retirees with bigger accounts can still run out of money. Neither portfolio is wrong. They're 2 different bets on what John wants his money to do.